My first week of trading didn't go so well, but my second week got a lot better. One of the important things that I did was to learn from the mistakes that I made from the first week, as well as to focus on that Google call spread put spread trade that I did that actually paid out. I learned that I wasn't so good at predicting which direction a stock would go, but I have some talent in predicting exactly how far the movement could go. Instead of just buying a directional play, whether it's just the call spreads or the put spreads, what I started doing in the second week was to buy both. I would take my knowledge of a stock from the past, figure out how much it could move in either direction, and then bookend a call spread and a put spread in both directions. But before we get into that, I had a lot of people ask me about call options and put options specifically. I know that options can be a little bit overwhelming, specifically when you're talking about spreads. So let's start off by talking about exactly what they are. A call option is the right to buy 100 shares of a stock at a certain price by a certain time. So if you bought a call option on ARM Holdings with a strike price of $100 and an expiration date of March 1st, what that means is that you could buy 100 shares of ARM anywhere between now and March 1st for $100, regardless of how high the stock might go. If you don't exercise the option before expiration, it will either execute if it's in the money. In other words, if ARM is more than $100, your broker will actually buy you 100 shares so that you don't lose the option and the ability to do that. If at the end of day on March 1st, ARM Holdings is less than $100, then your call option just expires worthless. When you buy a spread, it means you're going to be long one option and then selling another option further out of the money to make it so the overall trade costs less. And for this, let's look at a chart. Let's take a look at the Alphabet trade that I did that actually paid out. I bought two different spreads for this trade. My put spreads were the 142, 141 strike prices, and my call spreads were the 167.50, 170 strike prices. So what you can see here is that the green line in either direction is where the stock has to move for this to even be profitable at all. And it has to move in that direction plus the cost of the option. Because the call spreads cost me $15, you have to divide that by 100 to figure out what that would mean to the share price. In other words, instead of being 167.50 where I'd be at break even, I would actually need it to go up to 167.65 because it has to accommodate for the cost of the option. The put spreads only cost me 13 cents. So that means in order for this trade to be profitable in the other direction, I would need it to drop down below 141.87. which is dropping to the strike price, and then an additional 13 cents to cover the cost of the put spread. So now I'm going to actually replay the chart actions so you can see what happened and when this trade became profitable and why. After it reported earnings, you could see that Alphabet dropped right through that first strike price. This made it so that the option trade, the put spread, was actually profitable at this time. However, since I bought the options on the 29th and they didn't expire until the 2nd, you can see what happened. Here's the 31st, the 1st, and the 2nd, and it closed above the strike price. In other words, if I held on to those put spreads until after expiration, it would have expired worthless because it ended up closing at $142.38. It needed to close at 141.87 or lower. What I did was to sell the put spreads on this day. Now, if I had waited until Friday, I would have probably been able to get pretty close to the full profit in the spreads. But right now, I'm just learning how to do this. I'm going to worry about getting more of the profit range once I get better at this. The first step is to be consistent, to make sure that I can win more of my trades than I lose. After that, I can worry about making sure I get more of the profit spread and scale up these trades. So now that we've got that out of the way, let's take a look at the trades that I did in my second week and how they played out. I decided that I wanted to start tracking how well I did in each week of trading. And you can see that in my first week, the ones that ended on February 2nd, I did 8 trades, but only one of them panned out. So I had a 12.5% win-loss ratio. And you can see that I lost 61.45% of the money that I put to work. I put $147.66 to work and I ended up with a loss of $90.74. So not a really good turnout in that first week. The second week was when the options expired on February 9th, and you can see that I did a lot better. I took a total of 7 trades. Now, each trade is representing the call and the put leg. In other words, one trade is 2 different option spreads, the call spread and the put spread. So those don't count as individual trades. They're part of one trade. On the second week, I did a total of 7 trades, and I won 4 of them, which means that I had a 57.14% win-loss rate. Additionally, I ended up the week with $37.64 in profit when I'd spent $167.96 buying the options. In other words, I made a gain in the entire week of 22.41%. In addition to the 2-leg spreads that I bought, I also did a put spread on ARM Holdings. Now, I own ARM in my investments in play portfolio, and the call options were a little bit pricey. Plus, I had no idea that ARM was going to rally more than 60% after reporting earnings. So I just bought the put spreads, which of course expired worthless. Another key lesson that I learned was I bought the call and put spreads on Pepsi, and the problem was I bought too far out. Pepsi doesn't move that much after earnings, and I bought spreads that were more than 6% in either direction. That just ended up being a miscalculation on my part, and both expired worthless. But next up, we have the Disney play, and I bought the 88-87 put spread as well as the 105-106 put spread. Disney ended up rallying significantly after earnings. And at the time of expiration, the stock price was $108.37. So I could have actually gotten the entire call spread profit if I had held on to expiration. However, I didn't. The call spreads ended up printing pretty well, even though I didn't wait until expiration. So the spreads that I bought for $10.08, I sold for $64.96. This means I made a profit of $54.88, or 544% of my initial investment amount. Since I have to account for both the cost of the put spreads and the call spreads, I need to make sure I do that when I'm calculating my actual profit. So you can see I spent $10.08 on the call spreads. And if I look up here, I spent $10.08 on the put spreads. So I spent a total of $20.16. However, this means I got a profit of $44.80, even accounting for both of those costs, which meant that I made 222.22% on that trade as a whole. Next up, I wanted to do a trade on Palantir going into earnings. So I bought the put spreads with the $15, $14.50 strike prices, and then the call spreads with the $20, $21 strike prices. As you probably know, Palantir had a blowout quarter and ended up exceeding on guidance and on what the expectations were for the earnings quarter. So it ended up exploding to the upside. This meant that my put spreads expired worthless. However, my call spreads did print. In Palantir's case, I bought the put spreads for $13.08 and the call spreads for $12.08, which gives me a price of $25.16 for the trade. I ended up selling the call spreads for $50.92, which means once again, I more than doubled my money on that trade. In this particular case, I made 321.52% on just the call spreads, where the maximum profit I could have taken out was $87.92. I only got $38.84. Again, I'm not worried about that right now. When the options end up printing, I'm more interested in taking profits because, like I always say, you have to take profits when you got them, or the market will take them from you. But that is a lot to leave on the table. It's a bummer, but, I made 3 times the money on the call spreads and doubled the money on the entire trade. I call that a pretty good win. I also did a play on Pinterest, but in this case, Pinterest didn't move enough in either direction. So both the call spreads and the put spreads expired worthless. Next up is one of my least favorite companies on the planet. I have a personal beef with this one that goes all the way back to 2002, PayPal. PayPal has gotten a lot of bulls around it, and it seems like there's really positive sentiment, but I don't get why. This company just doesn't innovate. It has a very limited product service offering and doesn't compete well against Square or any of the other companies that offer similar services. Block isn't just a payment provider. They have an entire suite of services and offerings. And every time PayPal tries to make an announcement that says they're going to do something new, it's something really unexciting like one-click payments. The new CEO actually came out and said, this is going to be a shocking announcement. And then it was just one-click payments. That's ridiculous. So going into earnings, I was assuming this perennial disappointer would once again disappoint. And guess what? It didn't disappoint me. It disappointed its investors and sold off. In PayPal's case, I didn't even buy the call spreads. I only bought the put spreads. That's how much I hate this stock. However, here's what ended up happening. I bought the 57.56 put spreads, and they ended up expiring worthless at $58.91. However, I wasn't in it for greed. I decided once I bought them for $20.08 that if I could double my money before expiration, I'd just sell them and close the trade. And that's exactly what what happened. I sold them for $40.96, which means I ended up making 103.98% profit. In other words, I doubled my money. I made $20.88 off of a $20 bet. I'm not going to do very many directional bets like that, but this one I had a pretty strong conviction about. PayPal just stinks, and it always sells off after earnings. If you want fintech, you take a look at Block. But everybody's doing all this weird analysis, assuming that PayPal is undervalued. Companies have a way of being able to calculate how much revenue they have and how much they actually are worth. And I feel like PayPal is being miscalculated. It's been consistently bad for years, ever since it spun off of eBay. But enough about my PayPal rant. That was another successful trade. It was just the put spreads. The last trade that I did was Roblox, and I bought the put spreads, the $33.50, $32.50 puts. In Roblox's case, the call options cost more than the put options, so I only bought the $43.50, $44 call spreads. In other words, I limited my upside to only being able to make $50 on the trade. I spent a total of $16.08 on the call spreads and $16.08 on the put spreads. So I spent a total of $32.16. And after it reported earnings, Roblox popped up, so I was able to sell the call spreads for $38.92, locking in 142.04% profit on the call spread trade. However, since the call spreads were so expensive, I only made 21% on the entire trade because I have to account for the cost of the puts and the calls. But 21% in a week is still pretty insane. One of the other key lessons that I learned going forward is that I shouldn't buy either the calls or the puts in advance. I should wait until the day before earnings, and that's when I should put on the trade. I did already set up my DraftKings trade by buying the put spreads back on the 6th of February. But you can see that all I ended up doing was paying more money than I would have needed to because I didn't need 2 weeks worth of time. I only needed a couple of days. At the point of this video, I haven't bought the DraftKings call spreads yet. I'm going to wait until the day before earnings to do that. So if it ends up selling off before earnings, I'm not spending unnecessary premium buying these call spreads. If this is your first time watching the video, you might want to actually start at the beginning of this series. There's also plenty of other content on my channel for you to watch, and I'll see you next week.